Hey there, welcome to the Tocqueville Liberty Institute. I'm your host, Colonel Pete. And today we're diving into a topic that affects your money every single day, even though most people don't understand it: the fractional reserve banking system. By the end of this video, you will understand how the system really works, why it's problematic for our economy, and how it contributes to inflation eating away at your savings. Let's start with the basics. What exactly is fractional reserve banking? Imagine the scenario. You deposit $1,000 in your bank account. You probably assume your money sits there, waiting for you to withdraw it whenever you need it. But that's not what happens at all. In reality, the bank only keeps a small fraction of your deposit in its reserves. Hence the name, fractional reserve banking. The rest, they lend it out to other customers, businesses, or even use it to buy investments. For decades, American banks have operated under a reserve requirement ratio of approximately 9 to 1. This means for every $10 you deposit, they only keep about $1 in reserve and lend out the other 9. Pretty shocking, right? This is why banks require advance notice when you want to withdraw a large amount of cash. They simply don't have everyone's money on hand. If everyone decided to withdraw their money simultaneously, the banks would collapse. This vulnerability is called a bank run, and it's an inherent risk in the fractional reserve system. Now, here's where things really get interesting and concerning. When banks lend out your deposited money, they're essentially creating new money out of thin air. Think about it. The original depositor has $1,000 in the bank account, at least on paper, while someone else now has $900 in loan amount to spend. The original $1,000 has magically become $1,900. In the economy, this process of money creation doesn't stop there. The person who received the $900 loan might deposit it in another bank, which keeps $90 and lends out $810. The cycle continues, multiplying the original deposited money many times over. This continuous money creation leads to what economists call monetary inflation, where there's more money circulating in the economy by the same amount of goods and services. Prices inevitably rise. Your dollar buys less, and your savings lose value over time. This is one of the primary mechanisms driving inflation we're all experiencing. That's right. It wasn't always this way. The United States once operated under a gold standard where paper money was backed by physical gold. This put natural constraints on money creation. But since we abandoned the gold standard in 1971, our monetary system has been based entirely on fiat currency, money that has value only because our government tells you that it does. Without discipline imposed by a commodity-based currency, the fractional reserve system has been able to expand the money supply at unprecedented rates. The Federal Reserve Bank, or our central bank, can manipulate reserve requirements and interest rates to encourage or discourage lending, controlling the money spigot. Look at this chart showing the growth of U.S. money supply over the past few decades. Notice how it's increased exponentially, particularly during economic crises when the Fed loosens monetary policy. Each of these expansions dilutes the value of every dollar in your pocket. The consequences of the system extend to beyond just higher prices. Fractional reserve banking creates a precarious economic foundation that's prone to booms and busts. When banks create too much money through excessive lending, it often flows into speculative assets like real estate or stocks, creating bubbles that eventually burst. Moreover, the system disproportionately benefits those closest to the newly created money, typically financial institutions and the wealthy borrowers, while everyday Americans face rising costs for education, housing, and healthcare. Imagine how this might affect others in other countries, not in the United States. This phenomenon is called the Cantillon effect, and it's a major driver of wealth inequality. So, what does this mean for you? First, it explains why saving money in a bank account is actually losing you money in real terms. If inflation is running at 5% annually, but your savings account pays you only 0.5% interest, you're losing 4.5% annually. That means your losing power is being lost every year. Second, it helps explain why assets like real estate and stocks have seen dramatic price increases over time. As more money enters into the system, much of it flows into these assets, pushing prices higher and making them less affordable for average Americans. The pernicious effect of fractional reserve banking aren't always immediately obvious, but over time, this monetary alchemy transforms our economy, making it harder for average Americans to get ahead while artificially increasing asset prices. So, next time you hear politicians or economists talk about inflation as if it's some mysterious force of nature, remember, it's not just about government spending or supply chain issues. The very structure of our banking system plays a major role in eroding your purchasing power. That's right. Understanding this system is the first step toward advocating for monetary reforms that could lead to a more stable and equitable economy. At the Tocqueville Liberty Institute, we believe such an informed citizenry is essential for our economic freedoms. Thanks for watching. And if you found this video helpful, please like, subscribe, and share it with others. See you in the next video. Peace out.